Welcome, everyone. Thank you so much for joining me. And as always, a special thank you to every single one of you who has become a subscriber on Substack, Patreon, here on YouTube, or who has otherwise supported my work. I appreciate every single one of you. Is the Federal Reserve on the verge of more aggressive interest rate cuts this year, or will it change course? The Federal Reserve just sent a message, and it is not the one that many investors or policymakers were hoping to hear. This week, Federal Reserve Chair Jerome Powell made it very clear. Interest rate cuts are coming, but don't expect them too soon. Speaking in Providence, Rhode Island, Powell struck a very cautious tone, emphasizing the delicate balance that the Federal Reserve is facing between taming inflation and protecting the job market. His remarks came at a critical time, of course. The U.S. economy is now sending flashing red signals. Inflation remains above the Fed's 2% unrealistic target. It has been increasing in recent months, but right now the labor market is starting to soften. So this is the worst case scenario. Recently, I uploaded a detailed video on this very subject. You're welcome to watch it next. Some officials within the Federal Reserve, along with outside voices, mainly from the White House, are urging for more aggressive rate cuts to support employment and, of course, to align with Trump's economic agenda. But Powell, well, he's still not ready to rush. Let's break down his most recent remarks. I think this is very, very important, and it will tell us what to expect moving forward. At the heart of the Federal Reserve's mission are two goals: maximum employment and stable prices. And this is what we refer to as the Fed's dual mandate. In the past year, official inflation has been somewhat cooling, but not disappearing. And at the same time, unemployment is edging up. The Fed is trying to walk a very tight rope, lower rates too quickly, and they will reignite inflation, keep them too high for too long, and the job market would collapse. Last week, the Federal Reserve made its first move of the year, cutting its benchmark interest rate by 25 basis points. It was a small step, and according to Powell, a necessary one given rising unemployment. But during that same press conference when Powell announced rate cuts, he also admitted that it is, quote, challenging to know what to do. It is very unusual to hear that from the Fed chair, and of course it is clearly a sign of just how uncertain the path ahead really is. Fast forward to this week, and Powell doubled down on that caution. While acknowledging the risks to both sides of the Fed's dual mandate, he didn't really indicate any immediate follow-up cuts. His message was very, very simple: better to be careful than reckless. If we cut too aggressively, Powell warned, we would leave the inflation job unfinished and need to reverse course later. In other words, slashing rates too fast could cause inflation to rise again, and then the Federal Reserve would have to raise rates all over again, start it all over, potentially causing even more economic damage. But not everyone at the Fed agrees with Powell's slow and steady approach. There is a growing divide within the central bank. On Monday, for example, this week, Miran, a Fed official who was appointed by Trump, came out with a starkly different message. He argued that the Federal Reserve should, quote, slash its key rate to as low as 2 to 2.5%, nearly cutting it in half from where it stands today. So very, very aggressive initiative. Miran's rationale is presumably that the labor market is weakening and inflation is showing signs of calming down. And so he believes that waiting too long could let economic cracks turn into full-blown fractures. Do you agree with this approach? Are you seeing inflation cooling where you are located? I would love to hear from you. Leave me a comment. But you know what? Miran is also not alone. Fed Governor Bowman also pushed for faster action. These comments underline a key tension. Some Fed officials fear that high interest rates are now doing more harm than good. They worry that without stronger support, job losses could accelerate and consumer confidence could decline, dragging the economy closer to a recession or a stagflation. But Powell, he remains unconvinced. His focus is squarely on making sure that inflation doesn't rise again uncontrollably. probably, after all, inflation has stayed above the Fed's target rate for almost 5 years now, and that is not a small detail. It is a central concern, as it should be, and many would argue that Powell is right. Chicago Fed President Goolsbee echoed Powell's sentiment too in a recent interview. With inflation having been over the target for 4.5 years in a row and rising, he said, we need to be a little careful with getting overly aggressive. In short, Goolsbee and Powell are saying, yes, the economy is cooling, but inflation hasn't gone away, and until it's truly under control, aggressive rate cuts could do more harm than good. This internal division within the central bank isn't just technical, of course. It affects real lives because when the Federal Reserve changes interest rates, it impacts borrowing costs for nearly everything: mortgages, car loans, credit cards, and business investments too. If the Fed cuts rates quickly, as Trump wants the Fed to do, it can make borrowing cheaper. And that often encourages people and businesses to spend more money, which boosts the economy, but it can also risk a rebound in inflation. On the flip side, keeping rates too high can choke off borrowing and spending, potentially leading to layoffs and economic slowdown. So what happens next? Well, right now, the Fed has signaled the possibility of 2 more rate cuts this year, but Powell's tone suggests that these rate cuts are not guaranteed and they won't come fast or without new data supporting them. The central bank says it is watching the labor market very, very closely, as well as consumer prices. If inflation continues to cool and the job market weakens further, that might open the door to quicker rate cuts, but at this time we do see an increase in inflation, so more rate cuts are not necessarily guaranteed. But for now, Powell is staying the course. As we know very well, this debate is also playing out against a political backdrop. Some officials pushing for faster cuts have ties to the White House, to President Trump, such as Stephen Miran, and of course Trump made it very clear that he does want lower rates now. At the end of the day, Jerome Powell's message is clear: the Fed won't be rushed. It is very cautious. It is on a cautious path, and that path is one that could disappoint some, but one that Powell believes is necessary to avoid greater risk down the road. Are you in favor or against more rate cuts this year? Are you in favor of more of an aggressive policy? Let us know in the comments below. As always, I would love to hear from you. Give this video a thumbs up, consider sharing it, and subscribe on YouTube. I would love to have you back for my next video. And if you would like a bit more content, check out my Substack and Patreon. Take care.